We're going to start with a keynote called basically Crypto Options, 10 Reasons Why. And I'm going to present Thalex CEO and founder, Hendrik Ghys.
Thank you all. The mic's okay? You can hear me well? Thank you all for coming in such great number. Would love to, of course, attribute it to the exciting theme of volatility, the great lineup of speakers. I think also in part it's probably the optionality of doing this in Lugano after Plan B, where people stay for the whole weekend in such a beautiful place. And then I'm very happy to see you all here. So I'm Hendrik. I'm the founder of Thalex, also CEO. We're here doing this together with Bitfinex because our exchange basically works closely together. We have an integration where Bitfinex customers can easily become Thalex customers, and so it's been a great collaboration. So maybe I'll start with just a few words on what Thalex is, and then I'll dig into the 10 reasons why I think options in crypto matter and why they will become a lot more prominent. What Thalex is, it's simply a crypto options and futures exchange. We also offer perpetuals. Our mission is very simply to facilitate better trading. And what is trading? So the best definition I've ever read about it is from a great quant called Peter Carr, and he describes it as trading being a view, having a view, and then taking a position so that if your view bears out, you make money. And if you can only trade with perpetuals, the views you can express are very limited, right? It's basically up, down, or flat. So what futures and options next to perpetuals allow you to do is you can open up this whole range of new views that people can express. You can express different parts of like the embedded interest rates across the term structure. You can trade volatility, and once you start combining options, you can literally construct any payoff you can think of. And so in the word facilitate, there's the double meaning there. We need to enable this form of trading, but we also need to make it easier. On the enabling part, I think our platform is developing pretty well. It's a battle-tested platform. It's highly performant. We start to get pretty decent liquidity in the perpetuals and the options. On the future side, we'll get it online very quickly with a market maker that's here in the room today. And then really the next challenge for us to grow is the education side, right? How do we make this easier to understand for people? And that's why our slogan is often like structure your thinking, structure your trade. Like we actually have to educate people on how to think about trading better so that they can then actually understand the value of options better as well. 10 reasons why. Here's reason number one. For options to grow, I think first of all, history is on our side. Options actually have more than 500 years of symbiotic coexistence with futures. Actually, it's interesting to think about derivatives as technology being a derivative of another technology, which is actually deep sea shipping. In 1498, Vasco da Gama sailed around the southern tip of Africa. And then in the decades after, they opened up this whole trade route, global trade. And so the role of futures there, it really started to develop. It became centralized in exchanges because it had to solve the problem of these goods being on the other side of the world and you want to transact in them. And so what a future is, it's really this tool to allow money to travel through time so that goods have time to travel through space. Now, the reason for a lot of the buyers of futures to transact was often to protect against price rises. But fundamentally, right, economically, psychologically, they're sort of asymmetrically sensitive to this price. They actually don't mind if they can buy it cheaper. They really just don't want to buy it a lot more expensive. And so options actually grew out of futures because there were a couple of these smart buyers who started going to the sellers and saying, what if I offer you a little premium on top of the future so that I don't have to take the delivery if I don't want to? And that's how options were born. And then in the 17th century in Amsterdam, they were already fully financialized and tradable as separate instruments. But that's sort of the first really important insights. Like options and futures are sort of very much joined at the hip. And you will always have an options market develop in any sort of asset class, because fundamentally, usually, there's this asymmetric sensitivity to price. So you basically take this future contract and you change just one thing, right? An obligation becomes a right to the buyer, but that actually transforms the whole contract, right? So mathematically, this right is easy to value, especially at expiration, because essentially you just look at where the price of the underlying is. You look at where you struck, for instance, your call, and if the price is higher, then you exercise the option, you pocket the difference. If not, you let it expire as worthless to zero. And so essentially, the payoff structure of an option then becomes a future with its downside leg cut off. And that's where then the option starts to inherit all these marvelous attributes. First of all, it starts to love volatility, simply because of the asymmetry, right? The same move up and down, you will benefit more to the upside than to the downside. And that's also where the leverage and the convexity comes from, right? Convexity ultimately means a very simple thing. If price goes up, the option goes up faster. If price goes down, the option goes down slower, right? You can think of an option as sort of this superposition of two positions, one where I'm in the future and one where I'm stopped out. And so on the right, you see like the delta function, the sensitivity of an option to change in the underlying price, is sort of this S-curve. It's dynamic. It's because it indicates the degree to which the option trades like a future or like nothing. Now, Arthur Hayes, right, who created the perpetual, he once said something I fully agree with. He says, like, the meaning of life is to find cheap convexity in any aspect, markets, life. I think that's very true. What I really disagree with him on is the fact that he said that perpetuals solve for convexity. And that's actually not true. I mean, you can think of like a levered perpetual as providing an asymmetry between what you can lose and what you can gain. But the problem is that it's sort of a junky, lower quality level of convexity. Whenever you use a perpetual with leverage, you actually put a stop. Either you put it there or the exchange does it for you. And that makes like perpetuals very path dependent. Really, a perpetual, you can think of it as an instrument where you're shorting volatility. You get very dependent on the path of the price, not just the direction. And options, therefore, are fundamentally complementary because they can be long volatility. The way I like to explain that to people who approach options from a perpetual trading experience is that you can think about exactly the same trade you can think about constructing the exact same trade in the sense that you start from like where you would long your perp and where you put your stop loss. And then instead of putting the stop there, you put a put option there. And then you can think of actually the option providing you the service of having this rechargeable stop loss. It basically acts as if it stops you out at the strike, but if price recovers, it buys you back in. And an option is essentially an all-you-can-eat stop loss buffet. Until it expires, it gives you an infinite amount of crosses through that level. And so then where a perpetual is a way to bet on trend, an option is then simply a way to bet on the same directional view, but where we first do this before we break out. Why do you pay a premium for an option? Because it's simply a premium product. It's the same downside protection, but it keeps your upside protection. Now, the other way around, perpetuals are actually very complementary to options as well. I remember in the early days of Deribit meeting the founders, and they'd been struggling for 2 years to get anybody to trade options. Nothing was happening. And then they copied actually the Bitfinex perpetual. And they were able to benefit from a lot of volume growth when Bitfinex was essentially having a lot of technical outages, having a business model that actually profited from liquidations. And so at some point people fed up and market share moved to other venues. Deribit was a big beneficiary. And once they actually had a liquid perpetual market, all of a sudden that option market started to take off. Because if you can delta hedge options as a market maker, you can actually tighten the liquidity in the options. So it's really actually perpetuals, very similar to the history that I described before. It's the perpetuals that actually allowed options to have their start in crypto. I also think at a sort of meta level that the weakness of perpetuals makes the options more valuable, right? Here I'm showing you the basically a visualization of the option tape around 10 October, where we had our massive auto-deleveraging event. You can see a vol spike. If you were long put options on that day and you had some limit orders in, you could have made astounding amounts of money. And so the fragility of perpetual leverage creates these liquidity shocks, creates these volatility spikes that actually also make options more valuable. So basically they benefit both from the liquidity and the occasional illiquidity of perpetuals. Now, options have different strikes and maturities. There's a whole spectrum, and a lot of people don't like that about them because that means, you know, you have to make a choice. But that's actually an incredible strength because it allows you to reveal across all these different prices what the market thinks about the distribution of outcomes. If you trade spot or perpetual or future, like all of the expectations of market participants are compressed down to a point. You have no idea what the range of expectations actually is. With options, you can actually see a probability distribution reflected in the price. So you can see what the market thinks about volatility. And if you look even more closely, you can think about like asymmetric volatility between upside, downside, and even like the demand for you know, crash protection in the tails. And that also opens up like so many more degrees of freedom in which you can trade. Now you cannot just trade the price. You can trade any price. And that property, it actually makes options sort of these Lego blocks almost, where they become composable and they also allow for much greater specificity. So one thing, of course, you could do if, for instance, if you don't know which direction the market will move, well, you can buy a call and you can buy a put. As I visualize it here as a strangle, and you can sort of bet on the move in either way. But the really interesting thing becomes when you start thinking about this property where you can get paid for your willingness to buy a dip. That probably won't happen. And you can get paid for your willingness to sell a top. That probably won't happen. And when you then think of combining these different legs, you can sort of say, I'm going to buy an exposure I want by selling an exposure I don't think I need. And that's where you can get like incredible trade structures. I think, for instance, call spreads are great because very often you think, okay, the market will go up, but probably not until infinity. And so then by selling some upside, you have a lower premium, you have a lower break even. And then you can do fun things as well, like risk reversals, where you sort of have a smarter way of expressing like a long or short view than you do with a future, just because you take the legs apart a little bit, and now you can benefit from the fact that, for instance, puts are cheaper than calls or the other way around. I think this is a property that treasury companies are starting to adopt. Metaplan is one good example. You know, they use that property of this ability to get paid for your willingness to buy a dip, i.e. by selling puts. They benefit from that as a source of income. And I think treasury companies are really a net positive for the space. And beyond just the impact that they have as a buyer and a marketeer of Bitcoin, they also do a good job of just educating people in general. And I think more people will start to look into options as they sort of try to understand what the treasury companies are doing with options that they want to invest in. Another secular trend that I think is very, very important in this ability to sort of convert perpetual traders towards options is just that they've gotten so much cheaper over the years. You know, in the early days of Bitcoin, you saw multi-100% of realized volatility a year. That had come down to 2021 to roughly 80 to 100 vol on Bitcoin, but that's still, by all sort of reference points to maybe equities and gold, that's still astoundingly volatile. And that makes actually options hard to price. It makes them quite expensive to just, for instance, systematically buy downside protection. And so it makes the trading also very, very cyclical. But what we really saw over the last few years, especially since 2024, is really the secular downtrend in vol, where it got as low as 30. And that actually makes options more affordable for the buyers of protection. Of course, you could argue for the sellers, they can pocket less premium, but there actually what's more important is the spread between the realized volatility and the implied volatility. There's still a lot of juice in your ability to create yield from selling options. But I think overall, it just makes it more of an orderly market. It makes it easier for market makers to price. And then as implied volatilities come down, they become more attractive relative to perps for structuring trades that are stop resistant. And ultimately, they're a bit easier to price. They're more liquid. Who is the addressable market for options? I think it's simply everybody who trades a perpetual. The most important sort of law of options is actually not Black-Scholes formula, it's put-call parity. It's the idea that actually a future consists of long a call and short a put at the same strike. And so if you trade a perpetual, it's essentially a future where you swap the cost of carry on a regular basis. You're already trading long a call, short a put. And so if people then just think about those same trading ideas, all the intuition, all of the knowledge of experience trading that they've built up trading perpetuals, they can just import that into options. Think about the same directional view. You start from the legs being connected at the same strike. Now you pull them apart a little bit. You have the risk reversal that I mentioned before. Then maybe you tell yourself, I don't like selling downside to get upside, so I'll just replace that by selling higher upside to fund lower upside. Then you have the call spread. If you don't know which direction, then you turn the short leg into a long leg on both sides. So it's very easy to sort of start from that fundamental realization that they're actually, every future is already the combination of a call and a put. You can start then from there to like map your views into smarter ways to essentially create your payoff structure. And then finally, reason number 10, I think options are just very beautiful. Right? These are the different Greeks you have. So on top we have delta. To the top right we have gamma, which is the change of delta. Then we have on the left we have Vanna. It's probably the most beautiful Greek. She's also very cruel if you ignore her. So this is how delta changes in function of volatility. And to the right we have charm, also charming. It's the change of delta in function of time to maturity. You know, the options tape is beautiful. Again, this is sort of the volcano literally that we had in 1010, visualized on the options tape, calls on top, puts down below. This is like the pattern of put skew emerging, where you see for the same deltas that in the last weeks puts have become more expensive. That's actually an incredibly important signal. The put skew in the last year has had an incredible track record. It was there to signal that you know, at low 80s in April we hadn't seen the downside yet. The put skew told you that the top in 126K that we saw last was not to be trusted. So it's actually a very interesting thing where if you even, so that's also what we try to do in our education, we say look at these option trades even just to inform your perpetual trading. And then as we try to show the beauty, as we try to give people the tools to understand what the options market is telling them, then ultimately that's how we hope we will convert those perpetual traders to try the options themselves. Are we on time? Yeah. Should we move to the next session already? Okay, some Q&A. Are there any questions?
You said that Bitfinex was trading based on the...
Sorry.
Yeah.
Hey, thank you. So you said something about Bitfinex. I used to trade on Bitfinex. It was my first exchange. And I agree with your statement that their edge was to trade against the liquidation. Do you remember the event with Zcash when they added the perpetuals before actually the ZEC was started mining? Okay, yeah. So it was pretty funny, I will tell you. So the ZEC mining progress during the first 30 days was linear. So on the 30th day it was fully mine blocked, whatever, 12.5 coins, I think. During the first day, they had around 40 coins mined. During first hour, 0.4 coin. And it was added on Poloniex the day it was, the moment it started trading, on BitMEX 2 weeks before actually the coin appeared on the network. What happened on BitMEX is the futures went like from 0.5 Bitcoin per Zcash to 1.5 to 4 to 10 Bitcoins. 10 Bitcoins, why? Because there was a maximum system mechanic that there wasn't a possibility to have bigger than 10 coins per BitMEX. BitMEX Sam was at the time on TeamSpeak on Waypool, and there was a big arguing because he said at some point, 10 coins per pair is our limit, technical limit, we can change it. And I was like, yeah. There was liquidity on short. So short at 10, shorten because there is no edge to lose it. At some point he said, okay, we will change because there was so much mess in the community at the time. It was at 7 o'clock in the evening or something like that. And I was like arguing with him, hey man, you just said this and I said that, I have big short position, stop, okay? Publicly, he didn't do that. But during that day, the auto-deleveraging system like work actually 3 or 4 times.
Yeah.
You could make a long at 0.5 Bitcoin in the morning or at the night, 1.5 first auto-deleveraging, 4 Bitcoins second, 10 Bitcoins the third one. So much Bitcoins to be made and lost at the same time. What do you think about the situation? Like,
I mean, it's tough to answer on specific. I think it's an interesting story.
It's an amazing story, yeah.
But I would just say in general, so that's another source of volatility, right? You saw it on 1010 now with Hyperliquid, with also a massive amounts of auto-deleveraging. It just all adds like path dependency to trades, and it creates these liquidity vacuums, where like the liquidity in perpetuals can disappear.
Okay, so let's say, what do you think about adding the perpetual to the non-existent coin? 2 weeks before the launch, with the linear growth of the mining to like, you know. On Poloniex, it hit 3,600 Bitcoin per 1 Zcash at the first hour or second.
Well, it's a derivative. Every derivative I mean, the core function of derivative is to create a payoff structure relative to an underlying. So it's basically, if you don't know the price of the underlying, you don't know the price of the derivative. And of course, like in DeFi, people love to speculate, and there is like there's a popularity with these sort of pre-listing contracts, but it's really pure speculation. There's not much.